Good morning, folks. Welcome back. Okay, we're going to do some analysis on the current market action on all the pairs that we watch. And then I'm going to go over some of the major points as to what led me to outline the levels as you're seeing in the charts. And the last couple of weeks, we've been pretty spot on with the market direction, certain levels that we've been noting. I've been forcing perspective on you on the daily chart. Some of you, are very appreciative of that now. In fact, I've gotten many emails in the last 48 hours because of the importance of this time frame having made its impression on you finally. Not all of you. I'm not inviting you all to send me an email because I get a lot of emails as it is. It's not necessary. You can just send me a tweet. That would be sufficient enough. But some of you are acknowledging the fact that looking at this time frame and relaxing a little bit, not demanding you to get in there 15-minute time frames and looking for setups and signals every day. This gives you the model on what type of trade you're going to be, because you can see the day trades. You already know what it looks like on the lower time frames. You already know what it looks like to be a one-shot, one-kill trader looking for that weekly range. You don't know how to trade them specifically or consistently, but you can see how they can form using this daily time frame. So I'm encouraged as a mentor to hear that feedback. I really appreciate getting that from a number of you already, and haven't even gotten through all of the content for January. Some of the folks that are in our mentorship, or the two that have voiced their opinion about concerns about whether or not there's any validity or value to this because I spend too much time in hindsight. Again, I can't tell you, any clearer than I've already done using the daily time frame. We're really mapping out what the market's doing. Submission to this daily chart is going to break a lot of your wills. It's either going to make you a better trader or it's going to force you to be reactionary on a lower time frame. And for those that have listened to the instructions about going into this month, it's going to forge a great deal of patience. It's going to force you to look for things that you don't generally look at. That means what the large areas of liquidity you're going to be drawing on price. So when we look at daily charts, every single day I've been releasing my specific levels of study, what I'm looking for in terms of the buy side and the sell side liquidity. Some of the questions I've got by email, and I think, if I'm not mistaken, I saw one on Twitter, but it wasn't as clear and distinct as the vocabulary used in the email. It was very direct and said, look, I need to know what's going to happen on the right side of the chart because we're talking too much on the left side. I need to know, what's going on here because I need to know I can trust the guy I'm spending my time and my money on. And, sir, you know who you are, and I'm not trying to, make a case about, any one particular opinion, but I just want you to be realistic about it, okay? When all of you look at the charts and all the analysis and the concepts that I'm employing each week, every time I give you a chart, recently here, it's certainly before 3 p.m. Eastern Standard Time or New York time. So it's in advance. You all have it. And I'm encouraging you to download it so that way there's no changing or editing on my part. I can't change that. Okay, so if I give you the levels on both sides, buy side and sell side liquidity, what should you be doing with that information? So I'm going to clear that up this morning so that way, and I thought this was pretty clear, but apparently some of you don't have an understanding of what it is I'm supposed to be having you do. So I'm going to have that also included today too. So we're going to start with that now. When I give you buy side and sell side liquidity, okay, what you're supposed to be doing is you have a range. It's been defined by me. Now, by default, I'm forcing you to look inside of a specific segment of price action. It's kind of like a bookend, okay? This is the ending point for the upside, and this is the ending point for the downside. And when price is in between these two areas, when I share it on a daily chart, what I'm encouraging you to do is study which side the market's trying to draw to. Imagine, I used to do this a lot when I was in middle school and grade school. I used to play with magnets all the time, and I would invariably take staples out of the paperwork that the teacher would give me, or I'd put little pieces of metallic flake from the shop, because we used to have a wood shop and metal shop, and I would take these little shavings and play with that stuff with the magnet, move the magnet around underneath the desk, and it would move the particles around. Well, price is just like that. Imagine a magnet being up here and a magnet being down here. As the price gets closer to one of these levels, it's going to invariably draw to it. It's going to jump to it. What you're looking for and you're studying on the daily chart is there's going to be obvious clues as to which side the market wants to reach for. It's either going to want to reach for the buy side or it's going to reach for the sell side. This is a skill set that you'll learn because institutional order flow, there's rules. Okay, there's things that you have to look for. There's fingerprints on how they move price from one level to the next. This exercise, by looking at a daily chart and studying where the buy side liquidity is, or the liquidity pool for buy stops, this is what we're saying here, or the sell side liquidity, or where the sell stops would be, they're pending orders. That's areas where new orders would come in or existing orders would be executed on. Because we don't have a real order book in the sense like Oanda has, they're showing you their order book, who's net long, who's net short, and where's the existing orders. That doesn't really exist in the sense that it's too vast of a marketplace. It doesn't have a centralized, here's where all the orders are, okay? So the algorithm knows by reaching back in time to specific price levels that are very generically defined. There's nothing ambiguous about them. You know, it's the main things we've already talked about. The main thing is old high, old low, because that's the number one thing that everyone's trained to do is put a buy stop above an old high and a sell stop below an old low. But you've seen this month that there's a great deal of validity to just focusing on this time frame, and by looking at the buy side and sell side liquidity areas that I've noted out, it's not that I'm trying to put out there a bracket of the marketplace and wait for one to get hit and say, now look how smart we are, or specifically me. I'm telling you which side I'm telling you before the fact where it's going. So I'm leading you to where you should be focusing because I'm trying to reinforce the idea of seeing it pan out over and over again. You're getting a subtle nudge by me. Hey, look, the market's going here. Okay? But this is where the buy side liquidity is. And look at every time it wants to go up there, does it want to stay in that direction? No. This candle went up, blew out the bodies of these candles over here, even the wick, and then rejected. This candle here, it started to go up. At one point in this day, it looked like a bullish candle. It was engulfing this body's candle here. This candle's body, rather. I always say that backwards. I'm dyslexic when I talk about candlesticks. The body on this candle at one time it opened here and had a full green candle at one time. Then it rejected and went lower and closed lower. So again, my question is, as you're watching each day, instead of opening these charts up and waiting for some kind of little notation saying, okay, we're going to buy here and we're going to look to take our profits here, or this is a new area to sell or anything like that, the idea is for you to get in here and draw up all kinds of notes in the areas that's open. Make notations. Note the fact that it was unable to get up there and hit that area. This up candle didn't even get touched. Then this candle here started bullishly, but look, they couldn't maintain it, and went down below the midpoint or mean threshold of this down candle. So is it indicating its willingness to want to go to these buy side liquidity, or is it indicating that it wants to go down to the sell side liquidity? Clearly, each day it's giving you clues that it wants to go lower. Now, using IPDA, all I'm doing is telling you where the large fund liquidity is. There are shorter term or near term buy and sell stops as well. Even though this is a big area where large funds would have buying interest and selling interest down here, you have these equal-bodied candles here. So there's going to be a small liquidity pool of sell stops below here. And now this new swing high, because as soon as this candle closes and before this candle starts trading, well, actually when this candle really starts trading, this candle has closed. So now we have a 3-bar pattern or a swing high. So liquidity would be resting right above this high here. But look at the bodies. We wouldn't need to get it all the way up there. All you need is the bodies of each of these candles in here. That represents a period where price was unable to, with a great deal of volume, make a move considerably higher. All it did was make one wick there. So both candles traded here. It opened here, tried to go higher, rejected, and then went down. So there was no real desire to get above this swing high here. This high with a lower high and a lower high here. It only just went above it. Just a brief, small little piercing of this high here and then rejected. By watching the daily chart, it slows things down considerably. And for some of you, that's a blessing because you're trying to make too many decisions throughout the week, which leads to too many trades, which leads to overtrading, which leads to hemorrhaging of your equity, even if it's a demo account. So by having these ideas on your chart and me nudging you, telling you, look, I believe that the buy side liquidity is going to be hit here, or I believe that the sell side liquidity is going to be hit here. I believe the range is going to maintain this level but still have a downward draw on price. We're in a larger consolidation. I noted this in the dollar index, but we were leading to this level here. We didn't talk about buy side liquidity. We didn't want to be a buyer up here. The underlying direction was we were bearish dollar. But sideways larger consolidation, what does that mean? That means that we're seeing a steady little drain lower each time, not a massive sell-off where it just keeps blowing through this. We've already seen price trade down below it, and this morning, at one time, it traded right back up to the body of these candles in here. So it's revisiting an old area of support. Now it's going to act as resistance, but now does it have a willingness to go much lower? It hasn't shown it yet. What day of the week is this? It's Tuesday. So there's potential that this could be forming a weekly low. You never know that. You never know that. So you have to look for clues. Just by looking at one chart, you can't come to the conclusion that, okay, the weekly range is forming the low here or the weekly range is forming the high here. You have to build in the ideas of all the other pairs and, like we talked about last night, intermarket analysis. What are the other asset classes and groups telling you what should be taking place? Should there be a larger, longer-term sell-off on the dollar index, or should we be seeing some consolidation or a reversal and resuming of uptrend? All those questions are answered by utilizing all these concepts and tools in concert with one another. So when we look at the daily charts, when I draw up buy side and sell side liquidity, number one, you've already got a predefined range. So don't expect much beyond that right now. Okay, at least don't expect it in the next 24 hours. Some of you get very ambitious about how you think the market's going to trade, and you'll start looking at up here, okay, or you'll look all the way over here, okay, and there's all these other reference points that are closer to you that you have to study. You have to see what influence they have on price. Because I'm going to tell you right now, when you look at charts like this, in hindsight, when we talk about, okay, we talked this was going to be unlikely to be touched, but we were talking about this most likely being touched for the sell side liquidity. When that's discussed in hindsight, it's frustrating to some of you because, number one, it doesn't equate to a trade. It doesn't equate to profitability. You didn't make any money off of it. And I can't change that perception on it because I've already told you that you're supposed to be learning how to discern where the market's going. Because you can't get this lesson right. I can tell you all day long entries and exit techniques on any skill set of trading, whether it be short-term, day trading, or scalping, or swing. It's still going to cause you to lose money because you're going to not understand what this particular time frame we studied all this month and still will for the remaining portion of this month has been telling you. Everything that I lead your attention to in this daily time frame will help you in every form of trading, but you have to make the notations, and each day give yourself a little notation like, okay, I gave you a chart, you print somewhere, you can type it out, you can go into MS Paint and put it out there yourself, or preferably, this is what I would do, I would print the chart out, and yes, it's going to cost you some money for ink, okay, but who are you investing the money in? I'm not getting that money spent on me, you're spending it on you. It's for your enrichment. So yes, print the charts out. You can print it out in a black and white gray scale. You don't have to use a lot of ink. There's settings on your printer. You can change that. But it's going to cost you a little bit of time to do this each day, and it's going to cost you a little bit of money over and above what you spend for the mentorship. But that's money being spent on you, and it's time that you're spending on yourself. No one else is seeing these notations, and no one else is going to get the benefit of having it. But every single time you see a new candle paint and a new daily chart is updated, you should be noting what you're thinking inside. Literally, write it down. It doesn't have to be a long-winded, explanation about everything you're thinking. What you think right now. I thought that the daily candle at one time today was bullish. I thought it was going to try to make a run for that buy-side liquidity, but it closed lower on the day. So now I have learned that this is a much stronger draw. It showed a willingness to want to not get up there on this candle, and then it confirmed it here. And we're below the middle of this down candle. So it should start making a run for that area over here. We shaded it in the red. So I should expect to see each day, see very little upside, and a lot of the candles range be on the downside, and it should stay with a down close. Here's Sunday's opening. Here's Monday's trading. Here we are on Tuesday. Okay. Even on Tuesday today, we've seen the price want to get up, but where's it going to? Just any old random place? No, it's going back to the bodies of the candles over here. And it's showing a willingness to sell off again. So it's finding resistance going higher still, even after it's gone below these lows. But it hasn't broke yesterday's low yet significantly. So we're just in a period of consolidation. It's weighing out whether or not it needs to be down here. In other words, is this justified being below these lows? Now, I like the fact, personally, that we went below here yesterday and we didn't come all the way back and close or trade above this candle's high or Monday's high. I like that, because if we would have done that today, and we still could, it's still got a little bit of time today, but if it goes right back up and closes above this candle's high, that changes the tune, okay, and now we would then really be looking for a run to the buy-side liquidity here. It would be wanting to draw a price up there, okay? Now, using IPDA, the interbank price delivery algorithm, when we have an expectation of what the market should be doing directional wise, okay, that's obviously going to come from a monthly, weekly, daily standpoint. Now, I haven't introduced anything with the monthly and weekly chart yet, but you're going to get that today. We're going to be talking about the monthly P&D arrays, where we map out what the higher time frame charts are doing, and where the algorithm will be seeking liquidity based on those ideas. Once you have that monthly and weekly teaching, once that happens, everything we've done so far for the month, it'll gel. You'll know exactly what you're looking for on the higher time frame charts, and after tonight, you'll know what it is that brings you to a daily bias or the weekly range. What direction should that weekly range be? Should it be up or down? And by that, it gives you a plethora of trading signals, because you could be a scalper or day trader or a short-term trader and trade one shot, one kills. When you have the idea of let's just say it like that. When you accept the idea that the market is pushed around by an algorithm, okay, it's sometimes a hard thing to accept, and for some of you, you're struggling. You just don't want to accept it, because I can't prove it to you by saying, okay, here's the proof of it, and here's the programmer of it, and this is where it's centralized, and this is where it's located, and here's the people that work on it when there's issues with it. I can't do any of those things. Okay, I can only tell you by showing you evidences of it before the fact and why it's going to do what it does in price. My only testimony to it is, if it didn't exist, there's no justification for me to be able to do the things I do in the chart. The levels I call, the things that we outlined before the fact, all those things come by way of my understanding of what that algorithm does. And because it repeats itself over and over and over again, to me, that would be enough to convince me. But maybe I'm just, too too gullible, I guess. But nonetheless, when we have our study on a daily time frame, when we involve IPDA data ranges, okay, let's pull up our dividers here. Now this is going to show each month. Each vertical line is a new month. Okay. And what we're going to do is we're going to show a range. Okay. Now this is 60 spaces over, or basically approximately 60 trading days. Now, I don't attribute anything to Sundays because I just think Sundays is a partial day. I used to make a lot of case about Sundays being a relevant thing because I wanted to trade every day. And Sundays sometimes gave us a gap, and then that would give me the catapult and all those patterns that we talked about when we were on baby pips. I'm not so concerned about Sundays anymore. In fact, I wish they didn't even exist. I wish they would just start trading on Mondays and not have a weekend day. But it is what it is, and some brokers and some platforms are going to have it, and some of them aren't. And like I said, that's one of the other reasons why, as a mentor, I wish they didn't have it, because it creates so many email questions that I just will answer here. Just disregard Sunday. Pretend it doesn't exist. Just focus on Monday. There's going to be times where Sunday is going to have an influence, but it's so rare, and it ain't worth it. Ain't worth even considering it. So we have a range of 60 days in here, okay? And what we do is at the beginning of January, which is right in here, the maximum data range is 60 trading days that we look back. So the look back period is seen right there, okay? So now at the beginning of January, as we begin a new month, what we do is we go back and say, okay, what's the furthest back we would look back for liquidity? We look back 60 days, okay? 60 days gives us this range here. So I'm going to add a vertical line. And the vertical line here delineates the marker as far as we go back in time. And I'm going to take the other vertical stuff off, so it kind of clears it up a little bit. The IPDA data range will look back about 60 trading days, and it'll define the range based on that. So what we've already done is we have now a new trading range. We have the highest high was here, because this trading day here is January. This trading day here is December. So we don't have this yet. But looking back, we would go back this far. Okay? So this is the highest high during this whole time before January starts. And this is the lowest low. Okay, so we have a range right there. So 60 days back, this is the low and this is the high. So this is where the buy side liquidity is on that range, and this is where the sell side liquidity is on that range. Okay. We also have $40 days back. Okay. Now you're probably saying, well, why am I worried about the 40 days if we encapsulate the whole 60 days, doesn't that do the whole thing? No, because I'm going to show you the difference and why it's important to have a 40-day range look back as well. We have this range here. Okay, so from this point of this high, and we have the lowest low would be on this actual candle. This candle's low, so we're going to have to look at that by moving it over and move it over a little bit here. Okay, so we have a new range here. Right there. And there you go. So we have a low here, and we still have that same high here. This is a low inside of that range. So from looking back, before January starts, as soon as December's last trading day occurs and closes, we can immediately go into looking at IPDA and defining where the liquidity pools are and where the large institutions will draw price. This is the low in the 40-day range, and this is the high. below these lows in here, sell side liquidity, where we're actually identifying right now why I just used this level here, why I told you it was going to go into this level, because I used IPDA's 40-day look back, and it gives us this here. Okay. Now, would we consider this high, even though it's in the range looking back 40 days, would this high be considered? Now, I'm going to ask rhetorically. I'm not looking at questions. I'm just going to assume that you're all nodding your head yes or no. Okay. The question is would you consider this high for IPDA? No, because it's already traded above it. So there's no liquidity here now. It's already been, it's been absorbed. We're looking for highs and lows. Now, this is the low end of the 40-day range, because looking back, this is the 40-day marker right there. So that candle's low is the low end, and then we have this low in here. So we would have sell-side liquidity at that low, which is also, not surprisingly, an old high. See how they line up? You're going to see there's a whole lot of overlapping that you never notice in the charts by doing this. You have a sell-side liquidity resting below these lows here. You can use the wicks, but we like to use the bodies because that's the bulk of the volume. And then the high is here. The next range is the 20. Didn't want to do that. And what I'm doing is I'm drawing it. See that 26, 25, 24, 23, 22, 21, 20. And that's a 20-day range looking back. That takes us right back down to that same area here, so that we have this low, so nothing's changed on the sell side liquidity. So we have this on the 60, 40, and 20, huge liquidity pool resting right there. Okay, so on the sell side liquidity, that's why I've told you the sell side liquidity is right there. It hasn't been gyrating and moving all around. It's staying right there. The whole entire month we've been looking at this particular level right there. The same high is maintained as well. So the buy side liquidity this entire month, has it been reached into? No, it has not. But inside this 20-day range, there's also, with this lowest of the low, we have this low in here, and we have this low when it was created, which went below this one. We have this low. We have this low. Now, think about what it's telling you every single time. Okay, this is what we saw here. Right there. That's the ranges you would have. The 60, the 40, and then you have the 20, which would be right there. So you're looking back to see where the stops are on the buy side and the sell side. Okay, that's just for liquidity pools. You're also doing it for fair value ranges. In other words, going back in the previous order blocks, whether it be bullish or bearish, but you have to have a range to close in. For instance, we have this is the last trading day of December, okay, and we haven't started trading in January yet. So you're looking back 20 days, where's the range? Okay, we have this low, and we have the defined high here, okay? So I'm going to take these little boxes off because I'm not sure if it's distracting you, but it's sure as heck distracting me. I want to make sure I can see the price. Let's take, don't want to take the line off. Take that off and take this off and this off. Not that, Michael. And by having that cleaned up, so this is the 60-day. I'll add some graphics on the recording. This is a 60-day look back. This is a 40-day look back, and this is the 20-day look back. We have the low here, okay, and we have the high here. So buy side liquidity is up here. Sell side is as it's been noted all month for January. So buy side liquidity, we have 1, 2, 3 times it tried to get up there. Buy stops will be resting above that. But between this low and this high, what ranges exist? Well, we have 2 of them. We have this range here where it expanded up. So this is a down candle right before the up move. So this is what? This is a bullish order block. Okay, so there's a bullish order block right there. Okay, price comes down, hits it. Is there a response? A little bit. There's the response that goes to the buy side liquidity. Okay, so it hit an area of institutional order flow, bullish order block, inside of the range, inside of the last 20 trading days. So if there's going to look, here's the hierarchy in all this. You want to look back in the last 20 days, regardless of what day it is. I'm just using the beginning of January to frame it out. You can start by looking at a market structure shift, okay, or a quarterly shift. Find that most recent one in the last 3 months. You can start there, or you can start at the beginning of the current month you're in. Or if you're in the middle of the month, you want to go back to the previous full month. You can start there. By doing this, it will automatically put you in sync. You can't mess it up because the range is 60 days looking back. It's going to force you to a range of a high and a low, and invariably it's going to show you where the liquidity pools are. All it's doing is giving you a mindset or a framework to work within, looking at how you should go into price, studying where liquidity pools, fair value gaps, and order blocks, which one you should be focusing on right now. By doing that, you'll see that it's very systematic. It continuously gyrates back and forth in these ranges. Excuse me. So the last 60 days, that's the majority of all the working ranges you're going to work with. You don't have to go farther than that many times. Now, if this occurs where you blow out the buy stops and or the sell stops have been blown out, the highest high and the lowest low in the last 60 trading days, if they've both been violated and we're back in the middle of the range, then you just start looking at the ranges on the 40 and the 20. But you still have to identify what the highest high and the lowest low past or to the left of the 60 days would be, because that's going to be the new open float range where the larger liquidity pools will be resting. And it's usually going to be able to find that on a weekly chart. And we'll talk more about that when we get into the discussion on that time frame. But for here, I want you to look, here's 20 days back. This is that order block. It hits it. There's a response. And goes right for the buy stops. Okay, so now you have a new range here. So this can't be here. It's this now. So this is your high, and your low is down here. Right there. Okay, so if the data range is here for 20 days. For 40 days, okay, it's this low down here and still this high. So what you're doing every single trading day, you're looking and see where is price being drawn. So now we have a higher high up here with this high formed with all these lows in here. We have now a new swing low here. So inside the last 20 days, we have sell side liquidity below this low, sell side liquidity below this low, and a larger sell side liquidity pool resting right in here. Watch each day as it forms. Now it closes in the gap here. Buy side liquidity is up here still. Sell side liquidity below this low, sell side liquidity, and again, sell side liquidity below here. It goes and takes the sell side liquidity out. Now, once this has been taken out on this candle here, there's a little bit of responsiveness right there. Boom, it hits it. Is it going to draw for the buy side liquidity? Or is it going to continue for the sell side liquidity? It's in consolidation. It goes up, closes in this little range, which we talked about. It's a gap, in other words. Okay, so in looking back, each trading day, all of these ranges, okay, looking back, they move dynamically forward. Every single new trading day, that's why you want to use like a rectangle, because you can just keep dragging it over one and looking back. And all you're really doing is looking back for the last 60 trading days and defining where the high and the low is. You're looking for any ranges in those last 60 trading days. That means a rally up like this where it creates a void where only buy side delivery on price has been made. Then you find a down candle. That's the one they're going to look to recapitalize. You see it here, even though it's a small little responsiveness on the part of a few days, it still was a nice bounce in there. It created a gap in here. Price came down, cleared out the sell side liquidity here, and then rallied here just to close in this little gap between these two candles here, because there was no buy side delivery. There was no green candles, nothing there. It only opened this candle here and traded down. So nothing was offered on the upside. So price came up and created that gap closure and then sold off. We saw consolidation, but now look, it takes out the sell side liquidity here and here. So what's the algorithm telling you it wants to do? Is it showing you that it wants to go higher, or is it want to go lower? It's only interested in sell side. So that means what? They're engineering a book that's heavily net short, and they're punishing those that want to buy. It's because they're attacking all logical areas of where sell stops would be. Once the sell side liquidity is taken out below this low here, we have a buy side liquidity pool resting above here and still the larger one up here. Now, watch. Does price give us any indication that it wants to go to the buy side? No. We have another swing low here. What has it done? It ran that sell side liquidity out. It's reaching for what? This whole entire larger sell side liquidity pool that's been talked about all of January. Price does what? Comes back up, consolidates a little bit, and takes out the buys of these candles in here, which we talked about. We could have seen it trade back up into this order block here, but even when we noted that, it showed us no desire to get up there. Didn't get up there at all. Rejected the interest of getting higher was not there. So where's the sell side liquidity at? Below here and below here. And that's what you're seeing today. So all you're doing is you're looking back 60 trading days to find out where these liquidity pools are, the old highs and old lows, where the order blocks are, where's the ranges, okay? And you're working in that range. You're trying not to spend too much time outside of that range and looking at other things. Keep your focus on that. Now, what's the cast forward? What's the approach to that? Well, when we have a new month, like we do here in January, and I'll change this color a little bit. Okay, so here's January. So what you're doing is once you have this beginning time, okay, it could be like you could start this on February, okay, and you're going to look back from February, go back through January, December, and November, and define the highest high and the lowest low. Okay, and that's where large fund liquidity pools are going to be resting. Large liquidity is going to be there. So by having a range of 20 days forward, okay, what you're anticipating is you're going to anticipate a high and a low forming in the next 20 days. Well, here's that new calendar month beginning here, and we're going to put a range of 20. Okay, and what this is doing is it's forcing you to anticipate swing highs and swing lows that form in this 20-day period. Once this occurs, it's going to give you the anticipatory skills to start saying, okay, in this range of the next 20 days, there are long-term trend followers on a fund level that use that range to get into long-term trends. And a perfect example is the turtle traders, okay? I'm not framing on that, but it's just true. Long-term trend following traders use these validations to get in sync with long-term trends. A 20-day break higher when it's a bullish underlying market long-term, that's a very good entry point if you look at it. I mean, it's hard to argue with it. The problem is many times the markets are not poised to go higher, and a breakout above the last 20 days high, many times it's a false breakout and it returns back in the middle of range or reverses altogether. We can use this insight going forward once we have a delineation that begins this whole count forward, just using the beginning of the month, okay? Once this occurs, you're going to count forward 20 trading days, okay? And in that range, you're going to be focusing on where the swing highs are. When we see a new swing high form, for instance, we had let me scrunch this over a little bit. Yeah, this is the swing high here. We have a swing high here. We have a swing low here. And a swing low is a candle that has a low with a higher low to the right of it and a higher low to the left of it. This wouldn't look like a swing low to many of you that study standard technical analysis because they tell you that you have to have two candles to the left and two candles to the right, and this probably wouldn't be seen as a swing low. It would just be a short-term low of some kind. But to me, the way I define it is any candle that has a lower high on either side of it, 3 candles total, that's a swing high, and a swing low is just the opposite, one candle with a higher low to the left and a higher low to the right. So we have sell side liquidity below this low, and then we have a swing high here, which would be buy stops above here. So sell stops below here and buy stops above here. In the next 20 days, you're going to be looking for where price reaches for that. It trades through it here, takes the buy stops out, then goes down for the sell stops below here. We're still inside this next 20 trading days. Every single time you see a swing high, it's taking that swing high out and then moving lower and running for a swing low. It's occurring in the range of 20 days. Once this occurs, okay, all you're doing is adding another 20 days to this, to 40. what's going to be discovered in your analysis is by having a period of 60 days backwards and 60 days forward, many times you're going to see a quarterly market shift in that 120 days period. You won't see it or expect it unless you start studying it like this, and you'll see it actually materialize real time, and you'll see the mechanics of it all. But the data ranges are just markers on how far to look back for existing liquidity. Looking forward 20 days forward, all you're doing is identifying when there's a new swing high and a new swing low. You're expecting that to be ran out, and you're judging whether or not the market wants to reach for those buy stops or sell stops. And if it's still reaching from one side only, predominantly, it's telling you what the algorithm is pricing in. It's going to go lower. So what does that mean? You go back and you look at the look back period and say, okay, this is where the sell side liquidity pool is here. This is where they're going to be taking price. They're not taking anything out on the upside except for this one here. But every single time a swing low is formed, they keep running that sell stop pull out. It's gone. And you can't gain any new up ground. It's only drifting lower, okay? So for me, I'll tell you what it did for me. It allowed me to frame trend. It allowed me to understand, it's easy. It's written in books all the time, higher high, lower high. I'm sorry, higher high, higher low, okay? Price keeps making higher high, price keeps making higher low. Okay, so therefore the trend should be higher. That doesn't always occur. It doesn't always occur like that. For instance, you have a low here, price is making higher highs, and you have a higher low. Price makes a higher high and a higher low. And it makes a higher high, and then something happened. What just happened? There's a change in trend there. And I wouldn't be able to see that as a new trader. I would be looking for trend lines and stuff, connecting all that stuff together, and it would be confusing for me. And because I'm very analytical, hyper analytical, I had to find out what would make this stuff be robotic. It had to be stilted. It had to be, because I'm a computer programmer since 6th grade. I was making computer programs when I was 6th grade in my math class. I think like that. I think very binary. And that's why I struggled with trading initially, because I expected it to be on or off, a 1 or a 0. It had to be binary. And for me, when I saw how these orders are introduced in the marketplace, how the markets are taken to a specific level and then taken to another level, okay, that facilitates trade. That means there's control. That means there's artificial intelligence behind it. That means there is a program. That means there is an algorithm. That means there is an element of stiltedness. In other words, it's a program. So if I know how to computer program myself, I can go in and look for the characteristics in price that would give me the validity of these assumptions. And by looking at this, the market didn't prove randomness to me. It proved order. There's no chaos here. There's order in this, but it looks chaotic. And when we look at price through the lens of retail things, it causes chaos, because many times the things that we learn in retail, it goes opposite, or it doesn't do anything at all. The market won't move. It won't bounce bullishly off of a trend line. Or when it goes below the trend line, you should be bearish, but it doesn't do that either. It just stays sideways. Those were the struggling points I had. But when I started looking at these ideas with a 20, 40, and 60-day range, it keeps me focused on what is the price telling me right now. I'm not worried about 6 months from now. I'm not worried about 5 months from now. I'm only looking at what's happened in the last 60 trading days, because that's where the money is right now. 60 trading days, somebody with bigger pockets and more money than me has put real trades in the marketplace. By knowing that, we can see the market has in fact moved higher. All we have to do is know where those lows are, and they're going to make a move on that. The algorithm can't jump unless you're taking a depegging from the Swissy and the Euro into account, or you're doing a Brexit. They don't do these dramatic 1,000-point shifts, okay? They don't do that. The market will logically move to predetermined levels. See, now think about it. In the beginning of January, okay, if there is a computer program, if there is an algorithm, I'm going to suspend the idea for a minute. I'm convinced of it, and you're never going to tell me that it's not. But let's assume there isn't one, okay? How would we go into the marketplace and justify to even consider the idea of it. Okay, we're a skeptic. We're agnostic about it. Okay, we don't know if there is an algorithm. Okay, well, logically, if there's a computer program, how can it know where everybody's order is? If there's no centralized broker or there's no central clearinghouse for it, okay, not every one of our orders are going into one location, how can an algorithm find everyone's supposed stop? Well, it has to go back in a predefined range. And the way an algorithm is or a program is written in computer language, you have to define a source of data. And because data in the sense of price, it's date and time stamped, and it's a value. It's a high and a low, and there's data points like the open and the close. So all it needs to do is say, okay, I got to go back 60 days ago. 60 days ago is here. What's the highest value in the last 60 days? Well, that's easy. That's down here. And what's the high? I'm sorry. This is the lowest low in the last 60 days. And what's the highest high in the last 60 trading days? That's up here. Okay, so there's your defined range. Now, go back 40 days. What's that going to do for the algorithm? It's going to find all of the shorter term highs and lows. Now, if this high is defined in the last 40 trading days, would the algorithm see this as a high of importance? No, because it knows by looking back in the last 40 days, it's gone higher than that. So there wouldn't be any buy stops resting above that. But this low here hasn't been violated in the last 40 or 20 trading days. So therefore, there will be liquidity resting below that. Looking back 20 trading days, the algorithm's going to say, okay, what's the highest high? That's here. What's the lowest low? That's here. What has it done? It's overlapped 2 time periods, 20 and 40. There's going to be a large liquidity pool resting below that. Light bulb moment. Ding, 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 ding. This is your note-taking section, okay? When you have a period at which where 20 and 40 and 60 show an obvious higher low, that's where the market's going. It's going to go there. It's almost a guarantee, a surety that it's going to go there. So if you have this idea, and I showed it to you this entire month of September. I'm sorry, September, good grief, I'm way off of my time. I'm looking at these old months down here. The whole entire month of January, okay, we're in 2017, Michael, get with it. The low that we've identified for sell-side liquidity is always it's been maintained at this level here. We haven't changed our opinion about where the sell-side stops are, where the market's going to draw for the low end. It's down here. The reason why I picked that is what I just explained to you here. Now, that's wonderful, Michael. I get that. I can see it in this chart, and it makes perfect sense to me. But how do I use it going forward? Well, once you have the range defined, and say you create a new higher high, or now we've taken out these bodies on these candles here, but we didn't take out the low yet. So this low still is the one to be watching. Okay, so 99.46. So we're looking for 99.45 to 99.40 for the sell side liquidity, and ultimately price may come back down to this old high back here for some support. Now, what the algorithm will do, okay, what the algorithm will do going forward, it will always look back. Okay, so in other words, when you cast forward 20 trading days, today, if I asked you today's date, obviously everyone should be saying it's January 24th, 2017. So if we were to add 20 trading days or 20 days to that date, we could all logically go to our smartphones probably and pull up what 20 days away from today's date would be. Well, the algorithm can do the same thing. So what it's doing is it's casting forward 20 days, okay, and it creates an artificial look back period from that time right there. And it'll look back through that time and say, okay, where's the high and the low? That's this high here, and now it's this low here. From this moment here, this is the part that's going to confuse you. But when you start doing this on your own and doing it, you'll see exactly what I mean. I can't do it except for do it every single trading day. When we get through the January content, every single trading day that we sit down, we do analysis, I will give you every IPDA data range for the 20 to 40 and 60, and why I say this level is going to be a stop run. This level is going to be the order block it's going to trade into. See, these are the things I just don't talk about. I just do it in my analysis. But I don't literally draw these boxes anymore because I just know where it should be drawn from by quickly looking at the chart, and then where my eye goes right to it. Okay, and you'll see what I mean when we start doing February analysis on a daily. We'll be going in here, and every day we'll be back into daily sessions. So that way, you guys that have gone through withdrawal, and you can only take so much of this Tuesday, Thursday live stuff. You want it on a Monday through Friday again. That's what we start doing again in February. So you'll see that if the data range is being applied every single trading day, you'll know what I'm doing, why I'm doing it, and then it'll make a lot more sense to you. But the cast forward, the benefit to that is, number one, you have a predetermined where the 20-day is, and you look back, okay? And as you would look back, you're going to see that this high is where the stops are. This high here is where the stops are, and then you have the low here, the low here, and the low here. Now, this is going to be dynamic. It doesn't stay static on your chart. So every time you have a new higher high or a lower low inside of the last 60 trading days or the last 40 trading days or the last 20 trading days, the data range changes. It shifts just a little bit. That part is the confusion part. And when I looked at the delivery of that teaching, that's the part that is missing, that even when I watched, I said, well, it doesn't answer it for me, because if I was watching this for the first time, it wouldn't make sense to me either. So I understand why the confusion is there. So you're not mad, okay? You're probably mad because you didn't get it, but you're not insane, okay? It's because I didn't do it an adequate job of describing it. But basically, all you're doing is just you're in the old days when we didn't have computer programs and charting software like we have here, we literally used to have to circle swing highs and swing lows. We call them ring highs and ring lows. When this was done, you would know where the market structure would be, and you would also see where the stops are. This is like a version of that, just with on steroids, because it's building logic behind the fact that the market's going to draw to these levels to facilitate trade. Now think about it. If the market is controlled by the central bank, they're setting the price every single day. They're moving price up, they're moving price down, and long-term interest rates are drawing price, to a specific level value-wise, fundamentally. But who's in control of the interest rates? The central banks. So that everything is controlled by them. Okay, the data in and the output is controlled by the central bank. So if they are in control of every facet of the information that we use to make decisions to trade with, remove all the other stuff and just focus on, okay, where would it make sense for them to go with price? Where's the majority of the interest at right now? It's below this low. Nothing of interest on the upside up here. They've already priced in a rejection on this high. They've already went above this high here. Every swing low has been violated, and there's nothing down here for support. There's no support down here. But there are orders below that low because they see that as a self-fulfilling prophecy that this is a doji of some kind, okay? And therefore, this was rejection, so therefore, this shouldn't be traded again. But that's where all the sell-side liquidity is, below this low. And then we have all this movement down here taking us down into the low of these candles here. But that's way back. This is outside of the IPDA data range because we've shifted forward now. We're over here. So this delineation for 60 days back is no longer valid. It has to be used from today's date because we made a new low here. We've made a new low inside this 20-day range. We keep making lower lows, and so we have to keep looking back. If you just have a range of 60 days looking back and determining where the highs and the lows are, whether they're short-term or long-term, you'll know where the sell stops are and the buy stops are. And you'll also, your eye will jump right to where those ranges are for the fair value trades for order blocks, like this range here. When it moved lower, it's going to come right back up and close that in. Price is going to be efficiently delivered whether you like it or not. It's going to happen whether we're prepared for it or not, whether we see it coming or not. Until you start doing things like this, you won't think like an algorithm. You won't think like efficient market delivery for price. You won't think about that. You're going to be thinking about patterns. You're going to be thinking about signals and entry techniques and order blocks for the sake of just order blocks up close or down closes, and that's not the answer. The answer is seeing where they want to take price, because there's going to be trades made below that low. Right now it's just hovering below it, okay? There's going to be trades if it gets up to this level here. They're logical areas where resting pending orders would be right now. By taking price to that level up there, what would it do? It doesn't make any sense to go from where we're at now to there. It doesn't make any sense. Can it do it? Yes. But it doesn't make logical sense right now. It makes logical sense for it to come down and blow out this low. It does make sense to do that because it's already shown an unwillingness to go higher. We went below the bodies of these candles, but it's left this wick. Now, everyone in the room, just for, I'm going to make sure you guys are awake. What is your low? What is your low on December 8th, 2016? What's your quote low for the dollar index? I didn't think about this before I asked. I tell everybody to use this Forex LTD platform because of the dollar index, so you're all giving me the same quote low I got. If this would have been euro, it would have been something different. Nonetheless, the point is you'll see that the low, if we looked at the high on euro, it'll probably be much different. But when we look at the ranges like this, all you're really doing is looking for old highs and old lows, old areas of where the ranges have been created, like this run up in price here, that created a little bit of a liquidity void. Price comes back, draws back down into it, rallies again. It creates a liquidity void here, runs up, price is only been delivered on the upside. This order block becomes valid. See, a lot of folks they don't know what order block to look at. They don't know how to map out and define an order block. They don't know what a fair value gap is. They don't know what old low or old high the stops are going to be placed above or below and what they would be rating. And when you think like we're defining it here, it helps provide the framework for you to get it. And it's only by you looking at it and seeing it and making notations. And yes, that means sometimes your expectation is going to be opposite to what you see happening in price. But it will give you immediate feedback. That's the point of this whole lesson in January, seeing it happen. And as we do it live going forward every single trading day and every single month remaining in the mentorship, you'll know why I'm logically saying that this is where the sell-side liquidity is, and that's why I think it's going to go here. It won't make sense sometimes when I'm talking about it. You'll have all these ideas that the trend lines are this, or the moving averages are showing you this, or Elliott wave is saying it's the Z wave of, whatever you want to attribute to it. Okay, the bottom line is it's based on the money. Okay, it's based on the money, and by you having this exposure every single trading day in the form of me telling you where the liquidity is and you making notations on your own chart, referring to it every single day, you are teaching yourself to trust what you're seeing in price. And it will repeat itself over and over and over again. You'll know what liquidity pools resting above and below the marketplace define the current range, okay? And by looking at the characteristics of each trading day, what it's doing, it's telling you what it's going to do. It's going where it's most likely being drawn. There's more money below this low than there is above this high. Think about it. What's going on since September? I get to talk about the month I was talking about earlier by mistake. What has happened in the dollar since September 2016? I mean, it's pretty obvious. I mean, the market's gone what? It's gone higher. There's so much money in the dollar being long right now versus how many people are trying to be short dollar. Now, granted, there's somebody that's sold highs in the dollar up here. Somebody's short, clearly. The market's been repriced lower. Someone is up here short. But what ratio do you believe has the majority of existing orders? Would it be those long holders since September, Or would it be the short holders just from the beginning of January? How much money is in the market right now on what side? The long holders have. Clearly, there's much more money, actual money, real trades in the marketplace on the long side of the dollar. So if the algorithm is going to be seeking liquidity and it's already shown a willingness to go lower, so that means who's long, who's short right now? The banks have a net short book right now. They're making money. Otherwise, they wouldn't reprice. They wouldn't reprice lower. So if they're allowing price to go lower, are they just going to take off their profits at any old, just willy-nilly low or any specific level? They're going to take it where there's going to be a large pool of buyers. Where is those buyers going to occur? I'm sorry, I'm not saying. They have to cover their position. They have to cover their shorts, rather. And they have to do it from a large pool of sellers, okay? And that's going to come in the form of these sell stops over here. So if we know that the market's been trading higher, clearly, it's obvious, okay? And that's why it's important to work on these higher time frames, because these long-term moves and these large liquidity pools, they move price around. They're not real close like a 15-minute chart where you can jump around 20 pips, multiple times in the same day and it still go nowhere. That generally doesn't happen on a daily chart. It's usually moving to some significant price level, and usually it's several hundred pips or more. So if these buys in here, the longs are long, they're going to protect their long position with sell stops. So if this pool of liquidity down here in the form of sell stops, if we can take price down to that level, these sell orders become market orders to sell at the market, which is exactly why and where the smart money shorts will look to cover. So these sell orders become orders to sell at the market to the willing buyers that have sold from these highs. All we are doing, regardless of what time frame we're looking at the exchange between one liquidity pool to the next, one order block to the next, one breaker to the next, one old high to the next old low. It's a transfer of money, exchanging, okay? And they're just like bus stops. You know where, I've only rode on a bus one time, but I understand the concept that these things have set times. They got to be at a specific bus stop location within a 10 or 15 minute time window, I think is what they do. But they have a logical route that they go. Okay? Well, when you look at the long-term chart like this, you can see where these stops are. You can see it. So if you know that there's a logical area, okay, then that's where the price is going to go. There's going to be passengers in here, and there's going to be passengers above these highs in here, and this high in here. They picked up more to go short. They picked up more to go short, and ultimately taking it down to an area where there's a big pool of, or a crowd of interest to get on the bus here. And that's what the price has done. It's moved to that level. So the banks can make a book both net long and net short at the same time. They can hedge. In the U.S., we can't do that. They've taken away our ability to do that. A lot of people got really wealthy doing that, because you can once you understand, just simple market structure. Once you understand that, you can make all kinds of money and almost next to never have a loss, because you're hedging all the time. And they removed that from the U.S. and now it's first in, first out, and you got to know what you're doing. Some of you guys are good with MT4 indicators. You can actually create an indicator that'll do this for you. I just don't know how. I don't know how to program in MT4. I've never taken an interest in doing it. I only use MT4 to teach through. I don't use this as my go-to platform, but as a teaching medium, I do. But if I was actually trading through MT4, I would obviously be interested in learning MT4 programming, and I would make all kinds of crutches for me to do things like this. But it's not necessary, because once you have the range, once you have a range of 20, every new trading day, if it creates a lower low or higher high, you just go over like that. You just keep adjusting it. You have one chart on your platform that you would just keep adjusting. Okay, and that would be the same thing with your 60-day, 40-day, and 20-day look back. All you're doing is you're encompassing the last 60 trading days to find out where that liquidity pools are. And those liquidity pools and those order blocks and those ranges and those gaps that would exist in the last 60 trading days, they are going to be traded to again in the next 20, 40, or 60 trading days. They're going to. So by having them outlined in advance, okay, you'll know where the market will logically go to next. It's not ambiguous. It's not guesswork. I mean, how many times have you seen these things unfold? Since September, everything that we've outlined predominantly on the higher time frames, they've come to fruition. There's only, I think, maybe 2 or 3 times where it didn't pan out. But the hit rate's unbelievable. And that's what you need to appreciate as a trader, because it gives you that foresight to know that it's not ambiguous. It's not randomness. It's 100% logical. It makes perfect sense, but it takes time to get to those. You got to get to that point at which you trust it, and then you can see it. All right, so the question is how do you use the look forward 40 and 60 periods if you keep moving your anchor? It's based on any new range high. In other words, if you look back in the last 60 days, if that high or low is violated, okay, that new high or low adjusts for the 60-day look back. Today is the day you're looking at it right now, always today. Always today, but you have to have some basis point to begin. You can start with the quarterly shift. This is the part that you determine when you want to do it and where you start from, because it'll automatically get you in line. As soon as you start doing it, within 3 days, you'll be in sync with whatever the market's doing. Regardless if you start 60 days ago or if you go back in the last 30 days or the last 40 days and find the market structure shift that took place. In other words, when the market made a clear turn and reversal, like we've seen here in the dollar index. Okay, we're using January here because we're in January, and the market structure broke down. We had a quarterly shift here. The market has shown a willingness to break down and go lower. When you do this, okay, say you started in December, you would automatically end up here. You would automatically end at this point where your higher high is seen here. So you defined the range already with a higher high, and you just start going forward from that point. Your anchor point is always dynamically moving forward one day. And you're constantly looking forward and looking back the same amount of days. Nothing's changing in that regard. So that's what I'm saying. In a couple days, it just simply goes to where you would be naturally looking anyway, regardless of wherever we all started. We could literally all start on a different calendar day. And within 3 days, we would all arrive at the same levels. We would all be looking at the same highs and the same lows, the same order blocks, the same ranges. It's not going to be different for any of us. It's going to be the same. Once you start going forward, the ranges force you to look at the same low, the same high, the same bullish order block, the same bearish order block, the same gaps. They would all be defined in the same data ranges within 3 days. You'll never reach the move forward periods because the start line keeps moving. My question is, how do you value? Well, Sean, that's what I'm trying to explain to you. The range is, you're only looking forward that day, that number of days, to anticipate new highs and new lows forming. But when you get 20 days cast forward, you're going to look from that point backwards and say, okay, where would it's going? You're forecasting the same thing you do, like right now in the beginning of January. We can look back 60 days and we can see that high and that low, where the highest high and the lowest low is. When we're looking forward, okay, we're looking forward to get what 20 days away from today is, delineate that moment. And then looking back in time from that moment, like we're imagining we're there in time ahead. Looking back, where would the logical low and high be? Well, if we've done that here, okay, well, not here because I already moved it away from there. This is 20 days. At this moment here, at the very first trading day of January, this is what you could have done. And this is what you start doing every single trading day. When you do this, you'll see exactly what I mean by it. Now we have a future level that we haven't even traded to calendar-wise on this day. From this point on here, we're going to look at every swing high and every swing low in the same manner that we do when we're looking back here. When we do this, we are identifying where the stops would be. Buy stops would be above here. sell stops would be below here, but then we took the lows out here, so then sell stops would be resting below here, then sell stops would be resting below here. Every time it keeps making lower lows, okay, this point is a forecasted reference point. You aren't there calendar-wise. We're still not there yet. We have a couple days to get to this day here. But at this moment here, 20 days forward, at that moment, we start looking at every single swing high and swing low, because that's exactly when we get to this calendar day here, IPDA going to be doing that. So what I'm trying to teach you is you're going to anticipate where future stop rates are going to be. That's the benefit of doing this. It's not a trade. You're going to trade on the look back part. To teach yourself the importance of how the IPDA algorithm trades and moves price around, that's what the look back, the cast forward portion of it is. That's what you're doing with that. It's that you're not trading on this. You're learning anticipatory price skills by this side of it. By casting forward 20 days, 40 days, and 60 days, in that moment here, like 20 days forward from the beginning of January, you're going to look back over that period of 20 days, and you're going to see, as soon as you made a swing high, the algorithm is going to see that at this moment here. So when we start trading here, the market's going to want to seek this swing high. It's going to want to seek this swing high because there's going to be buy stops resting above that. Okay? So the cast forward has no benefit. Okay? Just so in simple terms, the cast forward of 20, 40, and 60 does not give you some secret high or low formed, okay, or an entry technique. It's not an entry technique. It's to practice anticipating, just like the algorithm would do, the highs and the lows and the order blocks that would exist in that 20-day period. When we get to this point here, you'll be able to see how those reference points at that time or later will be used for price action. Just like when we look back here, 60, 40, and 20. Does that make sense now? Okay, Sean's saying he's got it now. I probably confused about 30 more of you. It'll make, trust me, it'll make a whole lot more sense when you're seeing me actually doing it every single day. Just know that the cast forward portion of it, because a lot of people were actually sending me emails saying, okay, I did this and it gave me the exact high, and I'm going to do this next week on the New Zealand dollar, and I'm going to nail down the low, or I'm going to nail down the high. And that's not what it's for. You're anticipating the high and the low that forms from that point on. You're going to see how that eventually becomes a reference point for the algorithm. Okay, and it's only the cast forward is only a form of future study. That's all it is. It doesn't build any advantage to your trading whatsoever. But the look back period, that is all executable levels. That's the stuff that you actually build your trades and frame your trades on. So when you're looking back, that 60 days, 40 days, and 30 days, all you're doing is looking for where the orders are resting, below the market or above the marketplace in the form of buy stops or sell stops. I mean, that should be understood by now. Everyone should know that. Above an old high, there's buy stops, and below an old low, there's sell stops. You're using everything in the past to frame your future trade. The cast forward portion of the exercise and the concept I'm showing you is for you to anticipate how the market will attack these highs and these lows once it gets to this point here. And once you see it a couple times, you'll be like, okay, I know what it means now. And you'll lose all this excitement because, well, I know what you're thinking. You're looking at it and attributing because it's cast forward and future is, what we're trying to predict. So therefore, I've given you some kind of algorithm or alchemy that predicts the high and the low 20, 40, and 60 days of that. And that's not what this does. It's a skill set that's arrived at by using this reference point. That's all it's doing. But it is beneficial when we use the look back 60 days. So if we use the range in the last 60 days, the 40 days, and the 20 days, that range is what you're trading inside of. Remember that for folks that have been following me for a number of years, do you remember I did a webinar called Trading Inside the Range? Do you remember it? Anybody in here that was part of that? Inside the range, okay, this is the understanding of why that webinar is so good, but I didn't teach anything in terms of the 60, 40, and 20. I didn't teach anything. I just gave you where's the most recent low and where's the most recent high. And did it trade up? Well, that's your range, and look, see if there's anything to buy in that range. Or if it's been a down move, wait for it to retrace back up to optimal trade entry and then sell it, and then wait for it to trade back down to the low. I was on the fence about whether I wanted to teach the 60, 40, and 20 in that webinar. I actually had it in my notes next to me, and I wanted to talk about it. I said, no, I'm not going to do it. I'm glad I didn't, but nonetheless, when we're looking back, the look back, that's executable levels. That's definitely forecasting. That's definitely usable information. That's not wasted time. That's not fluff. It's real things. The cast forward, just know that you're doing that as a means of studying future price action. And like I said, when we start in February, every single trading day, I'm going to actually applying this information. And once you see it, within a couple of days, you'll say, oh, I get it now. It'll make perfect sense to you. But for right now, just focus on the look back portion of it. That's the money making stuff. That's the points at which your trades are going to be framed on. That's the directional bias. That's where everything in the future is going to go. It's going to go based on what you see in the last 60 trading days, the last 40 trading days, and the last 20 trading days. The cast forward has nothing to do with being able to pick anything except for anticipating how they're going to run an old high or run an old low. Okay, so there you go. All right, let's go over to, so in summary, I'm going to put this little question box over here so I can get through this video. I'm going to try to finish it up in 10 minutes. We've cleared out the bodies here. The next logical area is this low in here, which would take us down probably into this old high. So we've probably got a little bit more to go on the dollar. We've already touched these candles in here, the bodies of them, and we rejected that. So unless we get back above the mean threshold of this down candle here, because that's going to be a form of valuation in here, we shouldn't see it return back to that 190 or 101 level. That shouldn't be seen again. If it does, then we're probably going to see a run for that buy side liquidity. So anyway, in other words, the market's heavy. It wants to go lower, and we're looking for lower prices on the dollar index. Let's go over to the euro dollar in here. We'll take a look at this particular currency pair. We did violate the 107.60 level, so the buy side liquidity has been tapped into above these bodies over here. We had yesterday's during the late New York going into Asia. We saw it go into that range, pierce it. And then today we saw it one more time just go above yesterday's high and has not yet moved any significant movement higher. And it hasn't really given up much ground either, so it's just stalling around here. So we were inside this range still, large consolidation. I personally believe that it has more potential to go higher based on the analysis I just gave on the dollar index. If it would have came down a little bit more and hit this candle's opening and then rejected, that would have been great. You're going to see that happen here on the cable. We have the bodies here, this down candle, hit that level here and then rejected. So I certainly expect to see that 25.94 level. I can't recall where I made this comment. I woke up this morning and it was bothering me. I know I said the 125.25, the 125.30 level somewhere in commentary. Some of you guys that are really just hardliners about taking notes, which I love you for it. I mentioned that level in cable, 125.25 or 125.30. I don't know when I said it, but I woke up thinking about that today. I don't know why, but if you can tell me where I said that, I appreciate that. But I still think that we're going to see 25.94 to 25.95 in that area. We could see it punch to 126 big figure. This is definitely bolstering confidence in that expectation because we've seen return back to old resistance, broken now support, so we should see some further upside. This could be a market maker buy profile underway, smart money reversal, accumulation, reaccumulation. We have a consolidation over here. Okay, so we could see it run above that level we talked about. I think it was yesterday. If it wasn't yesterday, I know I talked about it last week. We have equal highs up here, so we could look for that move to take us up into that 27.27 level. So 27.30, 27.50 in that area, we could see a little bit longer term for cable if we continuously see dollar erosion. And dollar CAD, we closed in that gap and then we've moved even lower. We have a mean threshold of this down candle. That would be the next objective. So let's add that. Let me do it properly because I'll make sure I got the level on here in case it does hit it to the pip and roll. All right, and then so 3120 is next downside objective. How beautiful is that, man? I mean, really, take a look at this reaction, okay? And this is for you two guys that are on the fence about the value of what you're seeing on the daily chart. You know, we're spending too much time in hindsight. That to me, that irks me. Like, I'm gonna be honest and be real candid about it. It irks me because these are the discussions that we had before the fact, and when the market was down here, okay, we're looking for it to trade up into this mitigation block, and the mean threshold of the candle is exactly right to where it hit. And we called for this level to be filled in over here. It filled in that level. You know, that's a lot of movement. That's a lot of movement for a pair like this. I mean, usually CAD, I mean, just in recent months, it's been a lot of volatility for this pair. But historically, it's not really a very volatile pair. It's not. And it's because of the oil excitement we've seen in recent years that's caused this pair a great deal of volatility. But generally, before we had all that volatility in oil, this is a really generally a quiet, very good bread and butter currency pair. Not that you can't make a lot of money when it's volatile, but usually it's a very low volatility pair to trade. But when it gets excited, like anything else, it's you know, it could be, you know, a very explosive market, just like anything else. But look at the daily time frame here, folks. I mean, really take this in. I'm not gloating. I'm not trying to beat my chest or pat myself on the back here. I'm focusing on the beauty of price action in its purest state. This is exactly what you as a trader are looking for. You want to be able to determine where the market has the highest probability of going to and reacting to. That's the basis of trading. Where are we at right now? Where can it go above us and where can it go below us? And which direction is most likely going to go? Is it going to go up or is it going to go lower? You have a decision. Once you have the decision, to what level is it going to go? And once it gets to that level, should I expect more movement in that direction, or should it consolidate and pause, or should it reverse? When we have these ideas, that's what frames the trades. Some of you, and some of the ones that have already left the mentorship, were too impatient. They want to jump to, just give me an entry. Give me a trade right now because I need to know you know how to trade. If we can't talk about this openly and you see what I'm expecting to see in the price on this time frame, okay, you've already seen enough of it in a lower time frame. On the higher time frame, this is where your bread and butter is made. As a career trader, this is it. This daily time frame, this is it. If we can't forecast this time frame with any measure of consistency or accuracy or validity, okay, if there's a storyline that can't be outlined before the fact, I said this before I started the mentorship, you would know right away. If none of these things work, you'll know right away. 95% of you are still here. Looking at the chart, look at it. I mean, it's behaving as outlined. Two levels. I mean, think about it. When we look at the time frame of the daily chart, it's a long time. You know, Andreas sent me a little sound clip, a voicemail thing. I'm going to find a way where I can attach it to the forum because I thought it was cool. It's encouraging. As a mentor to hear it, it's also encouraging for some of you that are here. And when we look at a daily time frame like this, it's easy to forget how powerful this is because the first thing is when you look at it, you're like, okay, well, this is a daily chart. I don't want to trade a daily chart because my stop needs to be too big. And I can't make a lot of money on a daily chart because it's too slow and my stops have to be too big. That's all going to change in January. There's a way to use this time frame to trade without having to be in a lower time frame at all and still do very, very well. It just takes a lot more time. But even that, look at that level 33.88. Look at that level. I mean, really, just take that in for a moment. What about that level stands out apart from what I teach? Because I'll be honest with you, I don't see it. I don't see 133.88 of any significance why that should have turned there. I mean, classic support resistance, there's nothing there. There's nothing there. Now, if I pull a fib up from the high made in December down to the low in January, I'm quite certain it's probably going to be some 62% level. I haven't done it. You guys can do it on your own to see if that's right, or maybe it's the 70.5 level, the sweet spot on the optimal trade entry. It could be that level. I don't know. Like I said, I don't use the fib like I teach, I taught in baby pips days. It helps define premium and discount markets, but apart from that, there's no magic in the fib, unless we're measuring midway points or thresholds like we did here for that mitigation block. But look at the responsiveness off that level. That is beautiful. And when I see things like this, even for someone who's been doing it for over 22 years, okay, real money, doing it live in markets where it literally hangs on whether or not you're successful or not, or you're losing money, Jack. To be able to see this, to be able to see it, anticipate it, and understand why it should be taking place in the chart, to me, that I never lose appreciation for that. I mean, taking trades and making money and getting stopped out and losing money and making money and finding setups, that's all of the business. Everybody has to go through that. But even doing it for 2 decades plus, it's amazing to see how much precision is available when you understand what it is that's taking place in the marketplace. Why should these levels make sense? What's the reason behind them? It's not just any old candle. It's not a pattern. It's a logic behind it. Why should that level be so significant? Because everything they used that was long in here, because it goes back to the same premise, they buy when it's going down. Smart money cannot buy in up-moving markets. They distribute long positions as markets go up. That's their hedging program. They buy when markets are going lower. They have to do that. They have to buy when they have willing counterparties to their intended purpose of trading, buying or selling. So in any down candle, in your mind, you're thinking they bought there. So if they bought there and it's traded higher, once we traded below that down candle here, anything that would be long has to be mitigated or removed from the marketplace. The middle of that candle is exactly that level right there. They went right back up, took those orders that were long, now they ran away. That's exactly what I taught in the free tutorials as it relates to mitigation blocks and understanding what breakers do, why that takes place. And this is on a daily time frame, not a hourly chart or a 15-minute time frame day trading where you expect to see precision because that's what I've made my name on. But the daily chart, folks, I mean, think about that. That's amazing to see that level of precision. And if that doesn't get you excited about the consistency behind what you're learning, it's not me. It's the concepts. It's the things that I'm teaching you. That's what you should be enamored by. Not the person of Michael, the fact that these things are so consistently seen in price. And you can anticipate them. You can anticipate the measure of accuracy that, in my opinion, can't be seen in other disciplines. There's accuracy to the point where you can be profitable, yes, but nothing delivers like this. And for the folks that just can't get it, you know, and you're leaving, go ahead, leave. I'm not worried about it. You know, it's not my loss. I mean, I know this stuff. And the things that you learn here and have already learned, they're going to have a lasting impression on your trading. Even when you complete this mentorship, you're going to be able to look back and say, man, I learned a ton of things. And when you be able to go into the chart, instantly know what it is that you're wanting to do, what level is the most significant level right now. And if it's not at a level that makes sense to be working off of, or it's making a way towards a level that makes more sense to you, that gives you exactly what you've been looking for all along. Context, framework, patience. See, if you don't know what you're waiting for, you can't be patient. That's why everybody that's a retail trader is impatient and they react too fast because they don't know what they're looking for. So you're learning. A lot of you have sent me feedback this month about the things that you've discovered by just only looking at a daily chart. And I'm so appreciative of that because, like I said, I had 2 guys send me, basically, I'm not real happy. And I hear you. I get what you're saying, and I appreciate your feedback. But you got to take a step back and take a look at what you're really being shown here, because you're literally learning how to forecast the marketplace on a higher time frame level that gives you every form of trading discipline at your disposal. At that moment, you know exactly what the market's going to do. And you can frame all kinds of trades on that, all kinds of trades. And it doesn't have to be one pair. It could be a lot of different pairs. Now, if we're looking at daily charts, it slows you down way down to now you can look at 4 or 5 currency pairs, because it's slow enough for you to build an idea and forecast an analysis for the outcome you expect to trade on. But you can't do that realistically if you're trading 20 pairs and you're trying to day trade and you're not trying to find a trade like that. Too many things to look at, like a dog in a meat market. You can't do that. You got to refine your focus to one thing. If you're a day trader, if you focus your time on the daily charts like this and say, okay, I'm at a level where the market has a real strong tendency to move lower right now, and I think it's going to go to a level like that 3190 level, okay, and I can key off of a level of some kind of intraday resistance, I can take a ride on that and go lower. You're not going to be freaking out when it rallies. You're hoping it does. You're not going to be overly excited when it starts making 40 pips for you, because you know that the daily time frame is probably going to send us down to that 131.90 level. And you'll wait. And when that happens, you'll get that epiphany, that veil lifts. You're like, oh, I know exactly what I am going to do as a trader. And I can't teach that to you. No one else can teach that to you. But you'll do that by the process of going through this mentorship. It'll happen for you. And I just want you to appreciate that, okay? And the 2 guys that are here listening right now, you know you're leaving, and I know you're leaving too. But I want you to go away with that, knowing that what you're learning, it works, and it's there. And we've been talking about it before it happens. So it's not hindsight when that happens. When we talk about something and it unfolds in the chart, that is not defined as hindsight. That's foresight. And appreciate that, okay? Go into the charts, on your own, every one of you, and just literally go through how many things that's been outlined in the before the fact, and then look at how many opportunities that presented for you, even in a lower time frame. Think about how many opportunities are there, and go back to it only takes 30 pips a week to double your money every single year. Suddenly, when you start thinking about that, because a lot of things you have forgotten because you're so excited about the next thing I'm teaching, the next tutorial, the next this, the next that, keep yourself rooted in the basics, that it doesn't require a lot. So now if we understand the daily chart, now here, think about this. I'm going to ask for some interaction here in a response. How many of you can appreciate the ease of finding 30 pips now, just in the time and the concepts that we've covered in January? Now, think about it. From Monday's opening in London to Friday's close, New York time, maybe 30 pips felt like an impossibility a year ago, or maybe 6 months ago. Every single week consistently find 30 pips. But do you think, honestly, you can't find 30 pips now? It's easy. So every single one of you have the capabilities to double your money if you're relaxed and you allow that process to take place and you don't overtrade. How do you keep from overtrade, Michael? How do you fight the desires to go in here and break rules? Well, you break them long enough and lose enough money, you're going to either make that change or you're going to change careers. By using this time frame, it forces patience. This is the breaker, okay? This is the breaker of wills, okay? When you trade on the daily chart, you are literally laying it out there and saying, okay, I am not allowed to do anything less than a daily chart. I have to do all my analysis on this. And I'm going to be honest with you, the folks that used to sit with me on a one-on-one basis, okay, this is where they'd say, look, this isn't working for me. And it's just, that's why I'm not surprised. I'm surprised that, it's only 2. But I had the same responsiveness from the folks that were sitting with me. They said, look, I want to learn how to trade the bond market intraday. And you're making me look at a daily chart. All week long, we're looking at this daily chart. Yeah, you're right, because that's what you need. You need that. You can't hire a mentor or pay for a coach to teach you, and then you tell that person, no, I need you to teach me like this. That's ludicrous. I mean, if you have the expectation that this person or this organization knows something you don't know, okay, and they are exhibiting the evidences that they can do it before the fact, submit to that process. If you can't do that, and I'm going to be honest with you, I was like that. I would not want to follow rules. 2,000 plus books. That's all kinds of rules. And I didn't want to follow none of them. Didn't want to do it. It wasn't until I sat down and said, you know what? I see all these intraday moves, and I had a job. I was filling vending machines, and I had to use a higher time frame chart like this. And then when it made sense for me to look at these higher time frames like this, I saw things periodically. It would be like I saw it, and then I wouldn't see it anymore. Looking at this from the perspective of day trades, I couldn't day trade. I was 13 hours a day out on the road. But I knew that once in a while, the daily chart would give me a setup. And if I could just find a way to find that setup on the daily chart, I don't need to be in front of the charts. I could be a trader and simply just put an order in and then wait for it to hit my order, and then I'll trade that way. When I discovered how price is being delivered, it made every one of my questions in the past as a struggling trader, they are all answered at one time. It was a very euphoric moment. And some of you have had that moment this month so far. Some of you are on the verge. By the things that you send in your email, the questions you're asking, you are so close to it. Once it happens and you see it, it will make so much sense to you. You'll know exactly what you're doing. You'll know exactly what you're doing, and it won't be so ambiguous. But I'm telling you, the way you get that is by going through every single trading day, looking at the charts, the things I'm outlining. I'm telling you to watch it, see it, study it. You need to experience it. As it's moving, when it looks like it's probably reversing, don't have any emotion about it. Don't say, okay, it's probably reversing here. No. Wait for these candles to close on the daily chart, because the story's not done until the candle's closed. Then you have a new storyline the next trading day, and you watch that transpire over the charts too. And when you do this periodically over a sample size of time, and I'm saying, about a month, okay, about a month you'll have it, and you'll trust it, and you'll see, you know what, there's a lot of validity to using these things, and it proves universal application. It's not just an intraday stuff. But you can't get any better money-making time frame than the daily, because that's where the banks are looking at. The banks are on this time frame right here all day long. Over the weekend, analysts are scouring over this time frame. This is the one. This is the money maker right here, because it gives you the storyline for every possible form of trading. Doesn't matter where you're at in the scope of position or scalping. It doesn't make a difference. It's all outlined on this time frame. And it's a beautiful thing because it doesn't require you to be in front of it every 5 minutes. Think about it. You have all kinds of time to plan and forecast trades. But you will get there, and when you do, it can't be taken away from you. You can't forget it. It's there. And it provides you a means of knowing what you're going to look for in the marketplace, why you should expect it, and what that means for you in terms of as a trader, and what opportunities are presented based on that. And we talked about on the Aussie dollar, 75.80, and this is an interesting point I want to make here in closing. The 75.80 level I outlined, and let me show you here. All right, over here we had outlined this high. We are looking for the market to move above this high, and the institutional level that represents is the 80 level. So the markets, we know that the markets like to go to the 80 level, the 50, the 20, and the 0 levels. The reason why is because there's a a buildup of institutional orders that come around that level. They like to use those levels because it makes it easier for them to process, and that's why if you trade on a little bit larger account, you'll see that your orders are a lot more efficiently processed if you use these levels also. So when you get to the point where you're trading prime broker and you have larger account at your disposal, if you place your orders around these levels, you'll see there's going to be no problems getting filled. They're real easy to get counterparties to that. But 75.80, that was the level we were looking for here, above that high. And I said that I didn't see much above that. Now, if you look at anybody on YouTube that knows my order block stuff or was introduced to it from my tutorials, they'll say, okay, well, look, here's that last up candle here. And, I'm going to draw a line on that candle right there and draw it out in time. That's where the price of all Australian dollars should go. And I mentioned in passing, I think it was yesterday, I think I did. If it wasn't yesterday, I did it last week. But this whole market movement here, we had a candle trade down here, then we had the market trade down in here, and it went up, and then we had this candle trade up a little bit and then trade down here. So really, all through this whole area, think about that analogy I use a lot with a paint roller. If you apply paint to a roller and you're getting ready to paint the wall of your home, let me do it like this so you guys can keep your focus what I'm looking at. Okay, this candle's wick is here, this candle's wick is here, and this candle's wick is here. Okay, this whole block of price in here, look how many times prices pass back and forth in that area. Okay, it was moved down here, then it came back up. So price has been delivered both sides here. Price has been delivered on that same range here, and it's been mostly traded here. So that's the reason why I said that I don't know what would be above 75.80, but 75.80 was the number. That would take us above the swing high to an institutional level. And look what's happening. I mean, yes, we're piercing just a little bit, but why isn't this thing running? Because it's already fulfilled an area of the stops, and there's no void up in here. Price has been efficiently delivered there. You see that? Does that make sense to you? Anybody not understand that? Awesome. Nobody's saying anything about not understanding it. And that's the reason why I think that this is, one of the elements when you forecast price, when you ask me, some of you will ask, how do you know a level is going to hold and it won't just keep on running? When you see things like this in the left side of the chart, when you see that, okay, price is really efficiently balanced there. Think of that as like a brick wall. There's no reason for the price to want to reach up into that. And if it does, then it will want to go above this high. Not just to this, because even this down candle had another pass through with this wick. So this has all been efficiently traded back and forth, both sides. So it only made logical sense for it to come up to clear out the stops here. And look what's happened. We've been able to not really see any movement above that 75.80 level. And it's moved to what? I think it's a 76 big figure. Did it get there? Yeah, 76.09. So it didn't move much beyond that. So if you were getting out 75.80 and it went to 76.09, are you upset about that? If you made 50, 60 pips? No. Nobody should be upset about that. But anyway, I know I went all over the place a little bit today. If the data ranges, hopefully I've clarified the importance of the look back is more important than the cast forward. The cast forward is for you to learn anticipatory price skills, and you'll see all that stuff, and you'll see actually being used in February going forward every single day. It only takes a second to do it, and that's the business on that. Real quick, Euro pound hit our level to the pip. We had a mean threshold outlined here yesterday. The low come in at 85.65, and the low is the level we have here, 85.65. So pretty neat, huh? All right, folks. Well, I appreciate you hanging out with me. I had a long session today. They don't usually stay this long, but because I don't see you live except for 2 times a week, we had a long one today. But anyway, I'm going to close this one. Wish you all a pleasant afternoon. Today, like I said, you have 2 teachings tonight, and I will get with you all tomorrow on what lessons you'll have released on Wednesday as well. Everything will be delivered by Friday, 8 p.m. for teachings for the January content, and again next Tuesday before we do our live session, you'll have the PDF notes for the month of January. At the end of Tuesday's live session, I will be sending out the satisfactory agreement for January's content and your wish to continue into February. That will be signed digitally. Even if your payment processes, your access will be denied if you don't sign the proof of delivery and as described for January content. Until I talk to you again, folks, wish good luck and good trading.